last pricing model. I'm going to briefly review what Helen talked about when she gave you this problem. And I'm also going to call on you guys, at least partially. I don't really know most of your names, but I'll figure it out. Let's see. Let's see. Nabil, what's your name?
Angela.
Angela?
Chris.
Chris? Huh? Jing?
Yeah.
Okay, Jing. So, let's see. So I had this problem here. Anybody remember how to do this? And I know you were here, Chandler, last time, right?
I wasn't here.
Oh, you weren't? Let's see, who was here last time? Raise your hand if you were here last time. I don't want to call on Helen because, yeah, she taught it. When she was here last time, but she wasn't paying attention, I remember that. Anybody else? Okay. So basically, you can pay $800 today to receive cash flows of 100, 200, 300, and 400 in the next 4 years. And alternatively, you could put your money in the bank at 8%, which is the discount rate. So would you take this project? So anybody want to tell me how you do this? All right, back there, since you're in the deal.
Yeah, do you just discount the cash flow like 100 over 1.08 plus
Yeah,
200?
and so the logic goes, you have your negative 800 cash flow, and then you have your cash flows. And so negative 800, of course, today is worth negative 800. What is $100 a year from now worth today? Chandler? 100 divided by what?
1.08.
1.08, right. So it's not, did you say 108?
No.
Oh, okay, so yeah, it's 100 divided by 1.8, as shown here. And so that's about 92. So that's basically saying, if you give me $100 in a year, I would give you for that $92.59 today. All right, 200 in 2 years, how would you do that? So somebody, okay, go ahead, Richard.
It would be 200 over 1.08 squared.
Yeah, 1.08 squared, so you take the squared, and you take the exponent to whatever year it is. And that's, of course, the formula Helen talked about last time, so I'm not going to go into that. But so basically, I'm saying that if you were to give me $200 in 2 years, today I'd give you $171 for that. Okay, $300 equivalently. And then, as you can see, an 8% discount rate kind of takes the present value down a lot. So in 4 years, if you were to give me $400 for that today, I'd give you less than $300. All right. And so then how would you evaluate whether this is a good opportunity? Well, Chandler again.
Sum of all the discounted cash flow and see.
Yeah. So basically, I summed them up for you. It's 796.22. So would you guys take this opportunity? No. Why?
Net present value.
Negative net present value of negative $3. So basically, a company is the same thing. You can think of a company as a generator of cash flows. Somebody answering their phone in here? Okay. Sorry. So you can think of a company as a generator of cash flows. This is a stock pitch I did last. Turn your phone off. Seriously. And so, yeah, a company is a generator of cash flows. Basically, a company is going to give you money every year. You can think of it that way. And this is a DCF I did for CBI last year. That's a Chicago Bridge and Iron. So basically, all of this stuff we'll talk about in later lectures. We already talked about some of the accounting stuff. But basically, you get cash flows. So it's basically like saying I can get 414 million in a year, 361 million in 2 years, and this will all be split amongst the shareholders. And so to figure out what the stock price of a company is, we really need to know how to evaluate the net present value of these cash flows. And that really is a DCF, but we'll talk about that later. Okay. So what discount rate do we use? Do we use 8%, the same thing as we use in the bank?
Let's do that.
Somebody who isn't talking. So one of you four over here.
Yes.
Go ahead.
Using average cost of capital.
So yeah, you'd be using something not, yeah, why wouldn't you use what you use in the bank? Well, all right, let me talk about it. I think I got bullet points here. So you wouldn't use the bank interest rate because stocks are riskier than banks, right? So you can think of this as saying that banks don't really do anything, right? You just put your money and they accumulate the money and they give you interest on it. Whereas stocks, they take a risk and therefore they should generate more money for that risk. So basically risk equals return, which is really what finance is about in general. So that's important. Warrant? No, I think I spelled Warner, right?
Nope.
No? How do you spell it?
Higher.
Huh?
The word next to one.
Oh, yeah, wow, okay. I just said that. So this was I put this together in like 20 minutes.
Have a really good Mardi Gras, Alec?
It was fun, yeah. I had to wake up at 7 in the morning to start drinking. Anyway, so risk equals return, that's basically conceptually what finance is about. So a stock is riskier than a bank, and therefore it should pay more money to you than a bank does, because they're actually doing something. All right. So that's the statement you should ask yourself. Taking the same amount of risk, where else could I put this money? And I don't have an animation for this slide, but okay. You can put your money in other stocks, right? And that's basically the thing. You can put your money in comparable stocks, and you can use their returns as a discount rate. So how much on average do stocks return yearly? What do you guys think?
Last year or on average?
On average, not like last 5 years, think like last 100 years.
50%?
A year?
6%.
a year?
Oh, a year.
4.
10.
Yeah,
6%.
it's a lot closer to 10. What, Richard?
I say 6.7 after inflation.
Okay, well, let's not think after inflation, because inflation, everyone's subject to inflation.
12%.
So yeah, this is 10 to 12%, I would say. There's actually a lot of different, I was looking it up trying to get a real number, but there's a lot of different opinions. But in the last, 5 years, they've returned like 3%, so not very good.
Yeah.
Yeah, so basically, you can use that as that's the rate that they should generate because they are stocks. And since they're higher risk, that's the rate they should generate. But of course, not all companies are the same, and not all companies have the same exposure to the stock market in general. So is there a way to implicitly calculate the required rate of return? Anyone know what it's called? My whole lecture is about this. CAPM, right. Anyone know what it stands for?
Capital price.
Capital asset pricing model?
There you go. Are you a finance major?
No, it's in the econometrics only.
Oh, okay. I didn't know that the econ department covers this. Alright, CAPM. So basically it's assuming that you have your risk-free rate, which it'll generate just that they don't do anything. But since you're taking a higher risk and they're actually doing something with the money, it should warrant a higher return. So basically what we use is the risk-free rate. Well, this is what's used in the industry at WUSIF. This is the treasury rate. Anyone know what that is? Back there.
It's pretty much the coupon, the yield that treasuries pay out, either T-notes, T-bills, or T-bonds.
Right, you're right. It's the yield that they pay out on treasuries. Anyone know what number it is about?
4?
0.14% in 3 months.
Oh, okay, 3-month treasuries. Let's think 10-year treasuries.
So, 4.5.
Yeah, it's about I think 388. Basically, if you want to find that out, you can pick up a copy of the Wall Street Journal. It's in that little top header row. It's in the middle. It's always going to be there every day. So that's what you should be using for a risk-free rate. There's a question as to whether treasuries are truly risk-free. It's not, the government isn't expected to default anytime soon, the U.S. government. If anything, we could just print more money and have inflation. That'll affect everything across the board. So technically, we can treat these as risk-free for now. All right. So we know that stocks are riskier than treasuries, need to provide a higher return. So basically, the return on stocks needs to be the return on treasuries, and then something, and then an extra risk premium. And that's what we call the risk premium. So some stocks might have a higher risk premium than other stocks, depending on their exposure to different risk factors. And so for everyone, risk factor is the stock market in general. Just by being stocks, they have risk. And then they can have idiosyncratic risk factors, what we'll talk about that later. Okay, so this is what a lot of smart people came up with. Some Markowitz and a couple other finance people came up with the CAPM. So basically, let me break that down. Return on assets, R, that's basically our stock. The return that it needs to generate just by being a stock is the risk-free rate, in our case the 10-year treasury, and the beta, and the market risk premium. So the beta, anyone know how to calculate beta? Someone who's not Richard. Come on, you guys all take finance classes.
Not me.
Okay, Helen.
So you regress the price change of a stock over the price change of S&P 500?
Yeah, and it's really important to say that it's the changes. It's not the price specifically against the S&P 500. It's the fluctuation in